Bloomberg News.
Our next guest predicted the current financial crisis back in 2006. He says serious risks remain in the global economic environment and markets. Here to tell us why he thinks the worst may be yet to come, Nouriel Roubini, chairman of Roubini Global Economics and professor of economics at NYU's Stern School of Business. Good morning.
Good morning.
So the worst is yet to come. How much worse does it get from here?
Well, the U.S. is going to have its worst recession in decades, worse than 1991, 2001, but most likely worse than the 70s and the early 80s. And now it's becoming a global recession. It's Europe, it's Japan, it's Canada, Australia, New Zealand, and there is hard landing in emerging market economy. We'll have a global recession this year and next year.
Okay. But how bad? I mean, in terms of, you said going back to 91, that's what it's going to be worse than what we saw back then?
Much worse than 91. I expect it to be the worst U.S. recession in the last 50 years. I expect a cumulative fall in output from the peak of 4% and unemployment rate going all the way to 9%.
Nouriel, what makes you so negative? I mean, you definitely did call the crisis that we got this year back in 2006, but you were negative for some time ahead of that, even before 2006, correct? You were pretty negative going into that. I mean,
yeah.
What gives you the indications now that it will continue to be so bad next year?
Well, every macro news that has come out for the last few weeks has been awful and worse than expected. Consumption, investment, housing.
Right.
We have a free fall in retail sales. Housing is not bottoming out. Now firms have a credit crunch. There is no capex spending. Literally 85% of agri demand, consumption, fixed investment is now in free fall. So this is much worse than 2001 when consumption did not fall. It's much worse than 1991 when home prices fell 5%. This time around, they've already fallen 25%, going to fall another 15% before they bottom out. This is really severe.
When do you expect to see some of the results of all the central banks easing rates? I mean, they've knocked down rates an awful lot. Certainly the Federal Reserve Bank has pumped a lot of money into the system. When do you expect it to start having some kind of impact?
I don't think it's going to have any effect. The effective federal funds rate is already close to zero, 0.3, while the target is 1%. They're going to cut it another 50 basis points, but already close to the zero interest rate bound for the policy rates. The trouble is that the short rate policy rate might be close to zero, but market rates are going higher. The spreads of high yield relative to Treasury is now 1,400 basis points, like we haven't seen ever before. So whatever the Fed does doesn't matter for market rates. There's a major credit crunch, and firms are having a credit crunch. They cannot borrow, households cannot borrow, and the credit crunch has gone from subprime to near prime to prime,
right,
to commercial real estate, to credit cards, to auto loans, to student loans, to leverage loans, to corporate bonds. It's just a massive credit crunch. So it doesn't matter what the Fed does.
What will make a difference in your view?
Many things. First of all, we need a major aggressive fiscal stimulus, government spending on goods and services, because private demand is collapsing unless we have government infrastructure spending, giving money to state and local governments, unemployment benefits, food stamps, whatever that people are going to spend. So we're going to have a more severe recession.
So when they talk about infrastructure spending or something like that, you're supportive of that? You think
Absolutely.
That would be a good thing?
But we need something like a $300 to $400 billion fiscal package to be voted today. If we wait until February.
A new deal, as some have said,
Absolutely.
in terms of what FDR did back
Yeah, we have to, on
on
one side, to backstop Wall Street, because otherwise the collateral damage to Main Street is going to be severe.
Right.
But even if we bail out Wall Street, there is a collapse of Main Streets without a fiscal stimulus, then whatever we do to support the banks is going to be undone by a very severe recession in March.
Do you think we have to backstop and protect the automakers as well?
Effectively, yes. We're giving about $2 trillion to the financial system, giving essentially $50 billion of low-interest loans to automakers as a way to help them in their phasing down, because they are declining anyhow. It's something that politically is unavoidable. You need to do it. Otherwise, there'll be even systemic effects. There are about 2 million jobs directly and indirectly related to the auto.
We have no choice in your view.
We have no choice. Politically, you have to do something at least for Detroit. It's not going to change things, but you have to do something about it.
So we do get a bunch of housing data. You know, we talked a little bit about housing. I mean, how far along are we in this housing crisis? It's gone on for several years now.
Yeah, but, you know, home prices have to fall at least another 15% before
15%?
Absolutely. The cumulative fall in home prices from the peak is going to be at least 40% to bring them back to the historical norm. So this housing recession is just getting worse. People are not buying homes. Housing starts are collapsing. Building permits are collapsing. It's a vicious circle, and there is no bottom to it.
And
consumers are on the ropes.
And the consumer's a mess.
Yeah, the consumers are not spending even on non-durables, let alone on autos or big-ticket items like buying buying a home. Those decisions are going to be postponed for a long time.
Nouriel,
there is no bottom to the recession.
Earlier we talked about deflation. You've talked specifically about stagflation. Just remind our viewers what that's all about, what the consequences are of that.
Yes, stagflation is a situation which have economic stagnation and recession and deflation. Why deflation? When you have economic recession, demand is falling relative to supply, so pricing power of firms is reduced. They have to cut prices to sell. Then you have slack in labor market, unemployment surging. That puts a lid on wage cost and labor cost. And then now you have also slack in commodity prices. Commodity prices from their peak in July, they've already fallen by almost 30%. In my scenario of U.S. and severe recession globally, they're going to fall another 20-30%. So slack in goods market, labor market, commodity means that we're going to have to worry about deflation soon enough in U.S., in Europe, in Japan, all over the world.
And again, the only thing that gets us out of it, in your view, is it stimulus packages from various governments?
Yeah, because once you have it in a deflation trap, monetary policy is not effective. You cannot reduce further below zero.
They don't have much
policy
room anyway.
rates, absolutely, unless you do things that are very heterodox, like, for example, buying long-term government bonds or long-term corporate bonds. That's something that the Fed has not done. They might get to that point. In addition to fiscal policy, you need to do very unorthodox things on the monetary policy side.
Just got 20 seconds. You know, we've seen a lot of coordinated moves finally by governments around the globe. Are you anticipating that we're going to see coordinated moves in terms of fiscal stimulus plans by governments around the globe, just quickly?
Not officially, but the U.S. is going to have a huge fiscal deficit. China is going to have fiscal deficit. Japan is going to have fiscal deficit. A number of European countries are going to have fiscal deficit. But the reality is all these fiscal deficits are going to eventually increase long-term real interest rates because the supply savings globally is going to be falling. So that's a consequence of this very large U.S. fiscal deficit. $1 trillion next year.
Okay. Staggering numbers, to say the least.
Absolutely.
All right. Going to leave it there. Nouriel, thank you as always.
Pleasure being with you.
Good to have you. Nouriel Roubini, everybody.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP